On the 5th of December 2024, the Bank of Uganda Monetary Policy Committee maintained the central bank rate, CBR, at 9.75%. Domestic inflation has remained subdued. Over the 12 months leading to November 2024, annual headline and core inflation averaged 3.3% and 3.5% respectively. The stability in this inflation is largely due to the previous monetary policy actions that have supported the shilling exchange rate, declining food crop prices due to favorable weather, and the diminishing global inflationary pressures. Specifically, in November 2024, annual headline inflation remained steady at 2.9%, while core inflation slightly decreased to 3.8% from 3.9% in October 2024, driven by a decline in services inflation, particularly in passenger transport services. Looking ahead, Uganda's positive economic prospects, strengthened by capital inflows into the mining and the oil industries, could continue supporting the shilling exchange rate. Along with favorable food and oil prices and decreasing global inflationary pressures, this is expected to keep inflation low. The Bank of Uganda projects that average core inflation will remain below the medium-term target of 5%, averaging 3.7% in 2024/25 and 4.2% in financial year 2025/2026. However, inflation is expected to stabilize around the target of 5% in the medium term. There are, of course, several risks to this inflation forecast. On the downside, inflation could be lower if the exchange rate appreciates, partly due to stronger capital inflows related to the oil development, and also if the global growth and inflation remain low. On the upside, inflation could be higher if global inflation, which is still above target in several countries, reverses its declining trend due to heightened geopolitical tensions. Also, a severe depreciation pressures arising from tight global financial conditions due to potential policy reversals in advanced economies, leading to capital flight to safer havens. Geopolitical tensions, if this intensify, and then the disruption of trade leading to sustained increases in shipping costs or commodity prices, thereby lowering the global growth and further limiting the domestic economy's supply capacity. And if the weather conditions become extreme, this could drive food prices higher than projected. Overall, the risk to inflation outlook are balanced. On economic activity has remained strong with output around its potential. High-frequency indicators of economic activity and business sentiment suggest sustained strengthening in economic activity driven by resilient domestic expenditure. The GDP growth outlook remains unchanged since the October 2024 monetary policy statement, with growth expected to be between 6% and 6.5% in financial year 2024/25 and between 7% and 7.5% over the medium term. This growth trajectory is supported by strategic government interventions, increased foreign direct investment in the extractive industry, and the commencement of oil production in financial year 2025/26. Also, this growth outlook remains under considerable uncertainty. On the downside, growth could be lower if heightened geopolitical risks and potential changes to global trade and fiscal policies trigger additional economic shocks, disrupting trade and supply chains and resulting in higher commodity prices, especially oil. Also, the ongoing tightness in the domestic financial conditions, if this persists, could lead to higher borrowing costs, and increased domestic borrowing to finance fiscal deficits may crowd out the private sector and worsen the already limited private sector credit. And also, if the capacity of fiscal policy to respond to emerging global shocks is constrained, we could see growth lower. But on the upside, growth could be higher if government interventions result in improvements in productivity growth, and if investment is stronger in the extractive industry, and also if the global economy picks up, supporting exports, remittances, tourism, and foreign direct investment. And weather conditions that are favorable that support crop production could also lead to higher growth. So again, on the overall, the growth outlook are balanced. On this ground, the MPC noted that although inflation is projected to remain below the target in the near term, geopolitical conditions and policy uncertainty could contribute to increased volatility in economic activity and inflation in the short to medium term. Consequently, the MPC maintained the policy rate at 9.75%. The bands on the CBR remain at +/-2 percentage points, and the margins on the CBR for the rediscounts and the bank rates at 3 and 4 percentage points respectively. As a result, the rediscount and the bank rate remain at 12.75% and 13.75% respectively. We think that at the current CBR level, the monetary policy stance remains conducive to sustainable economic growth amid price stability that supports Uganda's socio-economic transformation. Future adjustments to the policy rates will be guided by incoming data and continuous evaluation of risks to inform the MPC's decisions. And our viewers and listeners, that marks the end of the reading of the monetary policy statement for the month of December 2024.